Hi, good afternoon everybody, and a very warm welcome to today's SME Club event. For those of you who I've not met before, and unfortunately it is just my voice that you're meeting today as my camera is still not fixed on my laptop. My name's Ruby James and I'm events lead at Virgin Money in Manchester, and we're delighted to sponsor today's event. So our teams have been working really hard to support customers with all of their money matters. So please do get in touch if we can support you with your business banking, or if you'd like to find out more about our newly launched current accounts and the benefits of being a Virgin Money customer. We'd also love to hear your thoughts on today's event, so do tag us in any of your social posts. We're at Virgin Money on all social media platforms. And today's event is Ways to Mitigate Risk in a Volatile Economy, and I will hand over to Stuart Carswell to get started.
Thank you, Ruby. Can I echo the sentiments from yourselves, and thank you for sponsoring this webinar. Thank you everyone for joining us this afternoon, and for Pro Manchester for inviting Pareto to be able to present. This is actually the second presentation, a follow-on presentation from one that I carried out about 2-3 months ago, when I think it's fair to say the market and the economy was slightly more depressed than it is after the announcement yesterday. There's a saying in politics by Harold Wilson that a week is a long time in politics, and just thinking back, this time last week we had Donald Trump still as president, even though he's still the president-elect, refusing to give up and handing a conceding speech. And we were outside of lockdown, about to go into lockdown, and everyone was wondering when we may look at progressing and getting a bit more positive with regards to getting back to some form of normality, whatever that will look at going forward. But after the announcements of this week, we've seen the markets rally, and I think it's fair to say we've seen a fair bit of optimism surge throughout the world. And today what I'll be looking at is a bit of cause and effect on a macro and micro level, and the effect that's had on volatility within the markets. But once we establish volatility, and volatility can be your best friend or your worst enemy, ways of looking to take advantage of this volatility, and also ways to look at mitigating the negative impact. And as I say, for those of you who were on the presentation, a couple of months ago, I will be reiterating some of the points, but trying to bring it up to date with some of the developments. So if we could move on to the, I'll do my Chris Whitty new slide, please, and moving on to the agenda, if that's okay, Catherine. I'm sorry, I can't see that, excuse me.
Stuart, you're in control of the slides if you just go on to the other tab.
All right, perfect, here we go. Can everyone see that? I don't know why I'm asking everyone, no one can reply. Catherine, can everyone see that now?
We can see the slides, but we're still on the first one.
Perfect. Thank you. So, the agenda for the presentation, a quick introduction in terms of who Pareto are. We'll have a look at succession planning and why is that so important in terms of seeing a starting point of where you are with regards to your businesses, looking at identifying the risks to your business, both on a macro level. So the three main risks at the moment are obviously COVID, the US elections, and also Brexit, but also at a personal level, what's happening actually on a day-to-day basis with SMEs and owner-managed businesses. Having a look at how we mitigate those risks, and also taking advantage of some of those. Obviously, there's a cost involved if you're speaking to professional trusted advisors such as your accountants, solicitors, banks, financial advisors, general insurers. So how do we mitigate the cost of that, making it cost neutral or even cost positive? And I have one case study, but I might just go over that, and there's a couple of examples that maybe are a little bit more appropriate. So, who are Pareto Financial Planning? We're a firm of independent financial advisors based in Manchester, working out of Manchester House. and we specialise in working closely with professional partners such as accountants, banks, solicitors, general insurance brokers, private equity, VC companies. And 90% of our clients are owner managed businesses. So we're slightly different than what our sector offers, because most of our clients are generally between the ages of 30 to 60, have their own businesses and looking at protecting that asset, which is generally the most valuable asset to them apart from families. We have a private and corporate division. So we look after both private clients, but we also look after their companies on the employee benefits side. We have just under 800 million assets under management, and hopefully with the way the markets are going, I think that will probably be over 800 million. I might get an ad hoc valuation of all of our clients' assets. We have 56 staff, 18 IFAs, and recently we've been voted one of only 2 IFAs in the Northwest in the FT Advisor Top 50. So with regards to that's who Pareto are. With regards to who I am, I'm a director at Pareto Financial Planning. As I mentioned, Pareto have hopefully now over 800 million, but currently 795 at the end of October of assets under management. All that means is that people trust us with looking after their money. I've extensive experience in looking after SMEs and owner managed businesses. We also have sports and entertainment clients, and we work particularly close with professional connections. My responsibility at Pareto is to look after those professional connections and develop any new business relationships. And I know quite a few of you personally from looking at the attendee list. So the purpose today is to look at how we can protect and maximise the value of our clients' businesses and your clients' businesses, how we establish a succession plan, identifying the risks posed to that, and how we mitigate these risks, making it as cost neutral as possible. Now, a quick start from the Institute of Directors. Only 32% of SMEs, owner managed businesses, have some form of succession plan in place, and only 9% have those written down, which is scary for me, because the starting point is always, well, where are you now? Where are you looking to get to? And how are you looking at getting there within the timeframes? And if you don't have an idea of that, a lot of our clients, shareholding directors, are very good at running their own businesses. That's what they do on a day-to-day basis. But what they actually need help with is on the professional trustee advisor side, is someone sitting down and saying, let's get a bit of strategy. Let's have a look at how we can build up the value. Let's have a look at how we take your business to the next stage. Let's have a look at some of the problems that maybe our other clients have experienced, and try and be a bit more proactive. And a lot of the time, the biggest asset our clients have is the actual business. They might have a house worth 1, 2, 3, 4, 5 million pounds. They may have pensions worth 1, 2, 3 million pounds, property. But a lot of the time, when they look at realising the value of their assets, it's the business that's the most valuable, and a lot of the time they don't really know what the value of their company is. So, why is succession plan so important? Well, it gives you a starting point. It establishes where you are, and from that, then you can look at where you're looking at going to. But if you don't have a succession plan, then you'll be running your business and looking, maybe not being able to plan and being able to mitigate the risks that are potentially day-to-day things could throw up, such as what we've gone through over the last 12 months. But we can plan for this. In 2008, we had the financial crisis, and I'll quickly look at the impact of that. We had the dot-com bubble, we've had 2 Iraq wars, we've had referendums, and the markets don't mind bad news. They love good news, but what they don't like is uncertainty. And sometimes it takes professional advisors to sit down with some clients and say, right, this is what's happening, we understand it, and this is how we're going to move forward. And we can only start looking at doing that if we know where the starting point is. Then we've also got to look at, well, what timeframes are you looking at exiting? and what value you're looking at on exit. And sometimes that isn't as much as what they anticipated. And the other thing is, if they are looking at the value today and the value on exit, they haven't quantified it. So a lot of the time it'll be, well, such and such sold out 2 years ago, my business is better than what that was. And everyone's own business is always better than the competitors, which you would expect. But let's sit down and have a look at the fundamentals. Let's have a look at what the EBITDA is. Let's have a look at what turnover is. Let's have a look at what recurring, any main contracts, and let's put a formal quantifiable value in place, working with an accountant and solicitor. And then let's have a look at working through cash flow. What actual value do you need on exit, and how are you going to exit? Is it going to be an MBO? Is it going to be a trade sale? Is it going to be a private equity? Are you just going to wind it up and take the value out of the business? So there's lots of different ways, but having a formal plan in place will allow you to get there. And with the economy where it is at the moment, it's a great time to relook, or even just start having a look at where you are, having a look at what your succession plan is, having a look at timeframes, and having a look at the value you require on the exit. So what are the risks of those? Well, obviously we've got COVID-19 as mentioned, the US elections which have just gone through, Brexit, but one of the biggest risks is how companies react to that. So if we just have a look at a couple of stats, and I know everyone will be familiar with this graph, and what we can see is cases increasing across Europe and the US. And what that means is there's a restriction of labour. And with the restriction of labour, obviously comes a decrease in GDP. And we saw in the UK a 20% decrease in GDP in Q2 this year. We also saw the FTSE drop from 7,600 down to 4,993, which is a 34% drop in value, and one of the largest drops over a 9-day period in its history. But we've seen the FTSE bounce back from 4,993, currently it's 6,244, and we've seen that a 20% bounce back. Obviously, there was quite a substantial increase of round about 5.5% yesterday. But that's the FTSE. The FTSE is made up of largely large and mega cap companies, which are international based companies such as Rio Tinto, HSBC, Vodafone, Glaxo. What really is more indicative of where the UK economy is and what affects our clients more is really what's happening within the FTSE and the FTSE 250, the FTSE 250. And that has been a lot more volatile than what the FTSE 100 has. And we've seen the FTSE 250 drop from 21,700 points back in March, and there was a 44% decrease down to 13,500. But we've seen it since March bounce back by 51% to 19,000 points. And I think it's quite important that if we have a look at the FTSE 250 being at 21,000, there was roughly a 50% decrease from March, and we've seen a 50% increase. But as you can see, we're nowhere near back to where we were pre-March, because the 50% increase is based on the 13,500 figure when it hit the lowest that it's been this year. So actually, if the FTSE dropped by 50%, we need a return of 100% to get back to where we were pre-crash. However, yesterday we saw, as I mentioned, the FTSE 100 increase by 5.5%. That put on an £82 billion of valuations on the FTSE 100 companies, and that's one of the largest single-day gains. It's in the top 10 single-day gains in the history of the FTSE. And obviously that's been driven slightly by positive sentiment and emotion, and some of these things will factor through. So I'm not saying it isn't positive, it is, but we've got to weigh it up while the markets drop, and we had some bounce back once the sentiment and emotion came through and people started applying fundamentals and strategy and logic. We had a reaction to the Pfizer announcement yesterday, and that increase has been driven by sentiment. We've seen some of the sectors increase. We saw leisure, we saw airlines values increase quite substantially, but we've also seen some of the decrease in some of the industries. So Zoom dropped by 17%, Peloton dropped by 20%, Just Eat by 8%, and Ocado by 11%. So that implies to me people are going to stop sitting in the bikes at home and going in some running machines, doing some Zoom meetings they want to do face-to-face, stop ordering takeaways. And I think people want to finally get out when we're able to meet face-to-face, have something to eat, and get back to some form of normality. If we have a look at, excuse me, the impact of COVID with regards to the daily cases in the US, we've obviously seen an increase, as I mentioned before, the increases in cases and also the increases in terms of sadly people passing away. However, with Biden coming in and with the Pfizer, we think that we're going to see the movement of labour in the US freeing up, and the Biden factor has already seen a 6% increase in the S&P since he was voted in last Thursday. I think it came out last Friday that he actually said that he'd won the vote. But the S&P is up at 3,550, which is one of the highest it's been. The MSCI closed at its highest ever in history, and the Nasdaq's been up 40% this year. So even although there's been a lot of bad news, that hasn't substantiated through some of the larger stock exchanges throughout the world, particularly in the FTSE and America. So we've got to take a lot of the bad news and the restrictions, not with a pinch of salt, because they're fundamental of what's happening out in the economy, but we know that these are temporary measures and there is light at the end of the tunnel. And if we have a look at the global corona cases, they've passed 50 million positive cases, and we've seen obviously deaths go up. And if you have a look at the graph, you can see that in the 6 weeks from March up until October, you've seen death rates increase from positive cases increase from 10 to 20 million, but only 20 days from 40 to 50 million. Now, hopefully, with what came out with Pfizer yesterday, and there's 40 million vaccines coming to the UK, once people start getting vaccinated, the temporary labour restrictions will start to free up, and we'll start to see the economies moving better throughout the coming year. So, with regards to the COVID cases rising, yes, they have, not only in the UK but throughout the world. The impact of that is we've seen a change in working patterns. So, I'm sure a lot of your companies out there have furloughed staff, and you've got staff working from home. And I was talking to Catherine before, and she's working from home. I'm working from the office 2 days a week. That will have a fundamental impact, but we have to ask ourselves: is that temporary? And once the vaccine does come through, are those working patterns going to change permanently and fundamentally throughout going forward, or is it just a temporary blip? I was talking to someone quite high up in one of the large real estate holdings, and they were saying it's going to have an impact on real estate in Manchester, but companies will still want a city centre office based. What the model may change, and what they'll be looking at, is increasing connectivity, such as faster broadband and Wi-Fi. They may have these pods where you can go in and do Zoom calls, and as opposed to travelling to London for a meeting, which might take a full day, you might be arranging Zoom and meeting calls from specific pods. So there will be a change in working patterns, and as companies we have to look at how we adapt to that. Cash is king. We've seen the government introduce some fiscal policy with C-bills and bounce back and furlough. Companies are sat there. A lot of companies haven't needed to use the C-bills and the bounce back loans, and it's just sat there because they're worried about potentially this second wave, which hopefully isn't going to come to fruition. But one of the big things is what are companies doing with this money? If you have a look at the inflation rate being around 1%, interest that you're getting on that cash being less than 1%, and true in real value, the value of that cash sat in bank accounts is zero. There are things that you can do to try and get above inflation growth, which obviously allows you to sit there with access to cash and grow that money above inflation. Routes to market. COVID has impacted the routes to market, so a lot of companies have adopted DocuSign and been able to get certain things passed through the internet, which has sped some of the processes up, but also slowed down some of the processes. So we've got to think about how the route to market affects businesses and our clients. And obviously, as I mentioned before, some industries and sectors have been affected more than others. And we saw in the close, in the first lockdown, we saw internet and let seats companies, Zoom, Peloton that I've already mentioned, supermarkets selling out. We saw their shares rally, but we've also seen those come back down with the mention of Pfizer yesterday. We saw travel companies shares decrease in value, and we've seen those pick back up. And it's important to remember one of the greatest things to mitigate risk is to have a good diversified portfolio and routes to markets as well. I was talking to an accountant just last week, and they look after push and pram chairs, and they largely sold to business to business. And they changed the business model. They started selling direct to consumers via the website, and it's absolutely taken off. So there are things that we can do internally, and we've got to be conscious of: is this route to market, is this the crisis just a temporary blip, or is it going to be something more long-term and fundamental? We've also seen the impact of the Bank of England stimulus. I mentioned the furlough scheme, CBILS, the bounce back loans. Obviously, furlough's been extended. For the first time ever in UK history, the British government is £2 trillion in debt, and at some point they're going to have to get that money back. So how are they going to do that? Well, there's only three ways: increase income, so increase taxes; decrease expenditure, so look at somehow reducing expenditure; and also use inflation. So if we can get inflation up, try and inflate a way out of it. And we've got to think about how the impact of those changes are going to impact on the economy and businesses individually. So moving on to the US election with regards to Biden. Already we've seen an impact, and Biden's come out. So we saw a 6% increase in the S&P from when Biden came out and said that he had won, and he's already come out and said that he's going to reverse some of the promises that Trump had already made, such as exiting the World Health Organization and the Paris Climate Agreement. He's mentioned that he's going to look at increasing infrastructure spending and increased spending on healthcare and education. So he's going down the Keynesian route in terms of economic policy. One of the things that Donald Trump did do is increase corporation taxes, which brought US companies back onshore. Decreased corporation taxes bringing US companies back onshore. And Biden said that he's going to start increasing these corporation taxes and also personal income taxes. However, the impact on the increasing on infrastructure spending and increasing on spending on healthcare, I believe that they're going to outweigh any increase in the corporation and income taxes. I suppose one of the big areas that could have an impact is if it's going to be contested. So January the 20th, we expect the inauguration of Biden. But if Donald Trump decides that he's going to start contesting it, then you've got this instability and the stock markets not knowing which way it's going to go. But we do expect Biden to be inaugurated on the 20th of January. So the US election, in terms of GDP in the US, the impact that will have, On the red line, you can see if it was a Republican sweep, in terms of the current policy, how that would affect, which is obviously because of Donald Trump, it would be roughly the same. Looking at the baseline on the economy and the impact that Biden will have with his infrastructure spending and infrastructure spending and the increased spending on healthcare and education. It's important as well that if we have a look at in the House of in the Senate, it may come down to Kamala Harris. If it's 100 seats, 50-50, it may come down to Kamala Harris having the ultimate vote on which way certain policies may go. And we know Kamala Harris is quite high on social and environmental responsibilities. And then if we have a look at the unemployment rate and the expectation on unemployment, we can see that the unemployment rate with Biden getting in would decrease quicker over the long term than if Donald Trump was to stay in. In fact, it came out jobs in October. The US had 638,000 more jobs in October this year, and the unemployment rate is reduced from 7.7 down to 6.9 in October, and it was forecast to be 7.5. And as we know, if the US sneezes, the whole world catches a cold. The impact of that, we've had 338,000 extra unemployed in the UK, but unemployment in the UK is still 75.3%. Last year, we're 0.8% lower than where we were in 2009, but it's still overall just under 5%, running at just under 5% unemployment rate, with the employment rate being 75, and obviously the other 20% are people that are sadly on benefits. Now, if we think back to 2008, Mark Carney came in and he was talking about increasing interest rates when the unemployment levels fell below 7%. So we're still a way off from where Mark Carney was back in 2008. They were above the 7%, and he was talking about increasing interest rates as soon as unemployment rate, fell below the 7%. So it is increasing. We expect the US unemployment rate to start falling. We expect the US markets to pick up. We expect that to have a knock-on effect within the UK, even though the UK unemployment rate has increased. We expect a knock-on effect that should slow down, but we're still not in a place where it's Armageddon as it was pre-2008. And then obviously the last big impact is Brexit and deal or no deal. The deadline day is the 31st of December, so if we've got clients out there that are dealing in the EU, everyone's got to be mindful of the impact that that's going to have. I would like to say that we know if there's going to be a deal or not, but we don't. What we do know is that there's going to be short-term volatility, and long-term, most studies have agreed that any growth is not going to be as high as it possibly would have been if we were still in the EU, but we're still going to have positive growth. So if we maintain the trend of the UK growth and we were in the EU, by 2030 we think we would have seen around about a 30% increase in GDP. Outside of the EU, we think it would be 24% increase in GDP. So it's not going to be as high outside of the EU, but we're still going to get positive growth. But we don't know. We don't know what trade deals are going to be signed, and we've got to think about our owner-managed businesses and how that's going to impact their day-to-day functioning of their company. I think what is safe to say is if we can get the fewest restrictions with any deal with the EU, the fewer the restrictions, the more positive that deal will be and the more positive impacts that will have on the economy. And at the moment, it's a game of poker. So we just sat there waiting to see who's going to fold, who's going to bluff, and it will probably go right up to deadline day. So with regards to the risks, What can we possibly do? Well, first and foremost, businesses should look at retooling. So look inwards towards your own company and think about what impact the macroeconomic factors are going to have. Look at the good practices that you've got that will function going forward and keep those. Look at the poor practices that you may have to adapt and look at retail. There's two great articles by McKinsey and Baines & Co, James Allen. If you put the great retooling, both McKinsey and Baines & Co, and they talk about going back to the Great Depression, companies that look inwardly, look at what's happening at a macro level and look at ways of adapting their business. They're the ones that will come out of the crisis as stronger, and they will get this exponential growth where the competitors may look at folding or alternatively get acquired. But that gives them a greater market share. We've also got to look at identifying risks. So look internally at the risks. Are there any key people that you can function with? Is your company structured properly? Do you have the correct financing? Are there alternatives? Do you have the correct contracts in place? So work with your professional trusted advisors and sit down and have a look at effectively doing a bit of a spring clean right the way through your business. And now's a great time to do it because you've got a new starting point of where your business is at. And look for long-term opportunities. With volatility, with changes, means that there are opportunities in the long term, and a lot of those opportunities are at a discounted price. So when there's volatility, obviously within the markets, you can look at buying low and selling high. But that also goes for business models out there in terms of other competitors who may be looking at being acquired, are looking at getting out of the market. People are looking at taking out new contracts. So there's times for negotiations. And again, working with your professional trusted advisors will allow you to take advantage of the volatility. And also it may be time to readdress your business model. So I mentioned before one of the companies that deals in pushchairs, they've readdressed the business model. I know another company up in Lytham, and again, they were selling largely B2B, and they've started looking at a B2C, a business to consumer direct offering, and they've seen that increase. And looking at long-term trends, this is the graph I was mentioning before with regards to beating inflation. So if we have a look at various asset classes from 1990, and we've got, excuse me, from the poll tax, we've got the Iraq wars, the dot-com boom, 2008 financial crisis, Scottish and Welsh devolution, referendums, the EU referendum, and we can see how different asset classes have performed. And if we have a look at inflation, annualised inflation of 3%, we have a look at what you would have got as cash in the bank with an annualised return of 4.84, and then you've got global bonds, equities, European, UK equities offering an annualised performance of 8% in the FTSE, and US equities of 10%. And obviously, the greater the risk, the greater the potential return, but also the greater potential loss, and the greater the return, the difference between return and loss is volatility. And what we're aiming to do is maximise the return you can possibly get while mitigating as much of the volatility as possible. So how do we go about doing that? Well, first of all, you should be looking at working with your trusted advisors. So now's the time to sit down with your accountant, sit down with your bankers and financiers, sit down with your solicitors, your advisors. Obviously, we'd be pleased to speak to anyone, and sit down with your insurers. And with the accountant, start having a look at valuing your business up. Have a starting point of where you're at, and have a look at working with the corporate finance and the tax side and the audit side to get the house in order. Get a succession plan in place. And the reason for that is at any point in time, you should know what the value of your business is. And if you work with a good accountant in corporate finance, private equity house, VC, they will look at being able to assist you in building up that value and being able to realise it at a time when it suits you. Sit down with your banks. Again, when we were talking before, Ruby mentioned about some of the policies and products that they've got in place. And it's worth mentioning that particularly with lending and financing, the market has changed. But the best place to start is sat with your existing bank and say, this is what I'm looking at doing, this is where I'm at, this is where I'm looking at growing to. I might need some working capital, can I have a look at my asset finance, invoice financing, and have that discussion. And obviously it'll be Zoom at the moment, but hopefully in the not too distant future that will be back either in the offices or in the Nag's Head. And working with solicitors, sit down and make sure that your contracts are tight, make sure your shareholder agreement stacks up, make sure that you've got an articles of association that's fit for purpose, make a power of attorney, make a will. I had a client, it was 2 years ago, £5 million business, 2 shareholding directors, 50-50 split, and one was 62, the other one was 52, best friends, played golf together, and everything was in place, just ready to be signed. And sadly, one of them had a stroke and was incapacitated and couldn't sign the contract. The whole deal nearly fell through because the clients didn't have a power of attorney in place. So sit down with your solicitor, make sure that you've got agreements and your articles, and also have a review of certain, it might be time to revisit any of your rental agreements. Landlords are quite openly recognising that they may have to be a bit more flexible. Sit down with your general insurers, make sure that the policies, your indemnity, directors and officers, cyber insurance, make sure that they're fit for purpose and make sure they're at best value. What I mean by that is not the cheapest. What I mean is that the policy is the best product at the best price. And then obviously sit down with your IFA and let's have a look at some form of protection both for shareholders. So once we know the value of your business and the structure, then we can put the relevant shareholder protection in place. And it's not expensive. Life cover rates have come down quite dramatically. Let's have a look at some key persons. With COVID, one of the impacts, we've seen a large increase in key persons cover because people have realised that some people are fundamental within an organisation. Let's get it protected. Let's de-risk the company by getting these people protected. Let's review your pensions. A lot of pensions, SIPs and SASs are sat in cash, and on the previous slide, getting virtually 0% return. But also maybe have a look at some form of cash extraction or looking at some corporate investing. We can get anything between round about 1 to 4% on some cash accounts, and so for instant access. And so for people that are sat, for companies that are sat on cash reserves that are getting virtually zero, there are ways for making that money work for you, but with still having access to it if required. And then the other thing is having a look at a review of employee benefits. So we, with COVID, we've seen how important having flexible staff arrangements, and it's important to make sure that we've got good staff. They are one of the biggest assets within our company. So have a look at your employee benefits arrangements. Mental health and well-being is a huge issue at the moment, and there are ways of reviewing some of your policies. We've got some of our providers adding it in free of charge. In fact, there was one solicitors that we work with, they had a private medical cover solely for the partners. They were looking at putting that out for all of their clients, covering all of their staff members, and they're paying around about £14,000 a year. We were able to cover all of their employees for mental health and well-being and reduce the annual premium from £14,000 down to £10,000. So it's a £4,000 a year saving, but all of the staff were covered, and also they were covered for health and well-being at home. So there are things that we can do. So sit down with your trusted advisor. And then protecting your business. I've just run through all of these. Work with a good corporate finance tax advisor, review your finance agreements, make your capital work better for you, ensure the correct structure and legals are in place, make a business will and power of attorney and also personal will and power of attorney, review contracts, take out shareholder protection insurance for the correct value. I had a company the other day we reviewed, and in the articles in the shareholder agreement, it was a company buyback of shares, but they had a cross option arrangement in place. It didn't work. It wasn't worth the paper it was written on, and the premiums. You may as well have just been spending them willy-nilly on a monthly basis. Ensure all key persons are covered for the correct value. Get your employee benefits updated for staff. It's not expensive, and obviously for a lot of the time we can put it through as a business expense. Review your general insurance policies, make sure they're fit for purpose and the best value, but also have a look at some alternative insurance policies. We've seen the impact that COVID can have on businesses, and there were policies previously that may have been able to cover for certain things. So if we look at all of that, to sit down with your accountant, restructure everything, revalue everything, sit down with your corporate finance, sit down with the solicitor, review your articles, your shareholder agreement, contracts, sit down with your general insurer, ensure everything, your general insurance policies are fit for purpose, and sit down with your bank to review all of your lines of financing. If it costs £1 per month, I think most people and most companies would do that. If it costs £20,000 per month, I think most companies would probably push away at that. However, what we're aiming to do with regards to the business risk audit is sit down with your clients and your banks and your general insurers and see if we can save you money. So review your loans and finance. See if we can save some money on your existing credit agreements. Review your employee benefits. As I mentioned before, we saved one of the solicitors we work with just over £4,000, which isn't a huge amount, but there is another company that we work with, and just by switching their group pension scheme, we were able to save them between £100,000 to £70,000, depending on how many of the staff members went down the salary exchange route. No one loses out there. The company contribution, net terms to them is still the same. The individual, the net term is still the same. It's just the same on national insurance. So these are true savings that will have a positive impact on companies. And review your general insurance policies. We work closely with a number of general insurers, and with one of our clients, one of our strategic partners was able to save £30,000 a year, but they had better cover. So review your loan agreements, review your employee benefits, review your pension schemes, and review your general policies. Make sure they're fit for purpose and cost effective. That doesn't mean to say the cheapest, but best value. And then, if I could just go back, as I mentioned before, we were on that saving. If you're looking at selling and you're saving, let's say £30,000–40,000 per annum on your finance agreements, employee benefits, and general insurance policies, apart from all the positive impacts that's going to have in terms of better cover, there's actually a true savings a lot of the time that we can put onto your bottom line or your client's bottom line. Now they can do that with whatever they want. If they just want to take it out as dividends or leave it in the company, it's going to make the company stronger. But when they're looking at exiting, and we're talking about maybe 3, 5, 10 years time, if we've added £50,000 onto the EBITDA and they're looking at an income of 5–7 times, we've actually added an extra £250,000–350,000 onto the sale price. So it's not just an immediate saving and a saving on an annualised basis. What we're doing is building up value for the sale price of that business going forward. So a quick case study, we had a recruitment company valued at £60 million, wanted to sell in 3 years for £20 million, turned over £6 million, EBITDA of £4 million. I know that seems strange, but effectively it It was a headhunting company. There were FTSE Boardroom 100 directors, and there was it was one office based in South Manchester with 6 staff. And the real value was, excuse me, was in the managing director's contact and black book. They had £2 million cash sat in the bank. It was 100% owned by one shareholder who was married with 3 children, and their accountant was very good at what he did in terms of he did his books, and he started off when the business was in its infancy, and the shareholding director was very loyal, so we just stayed with him. What we did, we introduced him to a corporate finance team. We got the accountant and the corporate finance to value the company. We restructured the company with a tax partner, put in a holding company in place. They did that. We looked at some cash flow forecasting. So why do you need this £20 million? And it was an arbitrary figure. It was just a figure that the owner was looking to achieve. The accountants restructured the company, preparing it for exit. We spoke to their solicitor, and we had new articles of association and shareholder agreement set up. We actually split the ownership between the shareholder and his wife. Reviewed some employment contracts because they weren't very strong, and that could have an impact on the sale. He put a business will and power of attorney in place. We had a look at, there was one person in particular who brought a substantial amount of the turnover in. We put some key persons for life and critical illness on that individual. We put some relevant life cover on the 2 owners, 2 owner directors now. We reviewed the company pension scheme, saving on the national insurance by switching to salary exchange and getting them a cheaper pension scheme from a different provider. They reviewed their invoice financing, the general insurance, and they added a cyber policy and a kidnap and ransom. So that was a solution. The result was the client had a quantifiable succession plan. He knew the value, it was substantiated. He knows the value that he was looking for, and it was less than the £20 million that he wanted. That's not to say not to build the value up, but if someone came in with £18 million, he could maintain the standard of living he was looking for in retirement, or once he sold, not actually in retirement, once he sold, rather than holding out for £20 million, it gave him the option to be able to accept the offer. He already had the term in place, but he was working with that corporate finance accountant to increase the value. They restructured some of the financing. We restructured the pension, restructured the employee benefits and the general insurance, and they saved £50,000 per year from all of that. We put some key persons and shareholder in place, and there was a one-off, the first year cost of £15,000 for speaking to the solicitor accountant and the refinancing of the bank. Ongoing, there was a £4,000 a year cost for providing the insurance. Above here, the key persons and shareholder, they already had the general insurance, but there was a £4,000 a year increase because they had the kidnap and ransom and cyber. So year 1 there was a £35,000 extra profit, but year 2 onwards there was £46,000. Do with that whatever you want, Mr. Client. However, if in 5 years they was looking at selling, then they've made a £219,000 saving over the 5 years. But if we assume an income multiple of 5 times, that added an extra £230,000 value on the business. So essentially what we're saying is, at times of volatility, it provides opportunity to be your best friend or your worst enemy. And the best thing that we can do is have a look at the short-term, medium-term, long-term impacts. Have a look at how that's going to affect the macro, but also the micro economy, and how it's going to affect individual companies. Look at the risks and look at ways of mitigating that. And if we can do it, cost neutral or cost positive, then we can add real value to companies out there. So it just leaves me to say thank you very much. And if there are any questions, You'll have to excuse me, Ruby and Catherine, I'm not cyber. I don't know how to get back to. I'll just delete that. Oh, here we go. There we are. I'm not sure if there are any questions. Adrian, thank you for saying my shot's a bit psychedelic. I didn't know it was like that. The reason I wear stripes going down, supposedly it makes me look thinner, but that's offset by the camera putting a few pounds on, so hopefully that's negated it. Well, there are no other questions coming through, so it just leaves me to say thank you very much for listening. If there are any questions, feel free to go via Catherine or contact me directly at Pareto. We're more than happy to sit down and speak to yourselves or any of your clients, and we'll offer a fee-free, no obligation review. We're quite happy working alongside professional introducers, and there's business out there. And after the announcement yesterday, and hopefully with Biden, there's a lot of positivity, and that will start coming through in the economy. So let's just take advantage of that. Thank you very much.